Hi there. So we're in the second week of February and let's see what's the action on the Nifty. So Nifty almost traded sideways in this week. It was down by 0.33% to close at 21,782. And even if you look at the advances versus decline ratio, it's almost reflecting the same story, a pretty much sideways story. 26 advances, 24 declines on a week-on-week basis. And in terms of the FIs, they sold 5,871 CR and DIs bought for almost the same amount, 5,326 CR. To a certain extent, that's the reason that Nifty has been stable even at premium valuations for that matter, because there is a lot of local domestic money at this point in time in stock market, and whenever FIs sell, DIs see it as an opportunity to buy, and that's why it remains stable. Now before we get into the specifics, I'd like to cover a quote today, which is also to a certain extent the premise on why we are doing these videos. This quote is from Intelligent Investor book. It says, "It requires a great deal of boldness and a great deal of caution to make a great fortune. And when you have got it, it requires 10 times as much wit to keep it." This something by a banker, German banker, Nathan Mayer. It's quoted in the book The Intelligent Investor by Graham Bell. The reason I am saying that you relate to it is that mostly, there's a bull market and there's a bear market. But if you look at the investor or the trader, it's the sheep market. We follow the shepherd trend, that whatever the rest of the crowd is doing, that's what we do. And that's why it says great deal of boldness and great deal of caution. So when the markets are at a premium, that time you have to have caution. And when the markets give you an opportunity and there's pessimism on your own portfolio, that time you have to show boldness. The way I would look at the current situation, I think it's a little bit balanced at this point in time. So you should not be holding up on your SIPs, but definitely there is caution needed because there's election coming up. And the markets are definitely trading at 5 to 7% of its trailing valuations from the last 20 years if we look at it. We've been covering that in our earlier videos because typically the markets have traded in the range of 20 to 21, but right now the markets are trading in the range of 20 to 23 of PE valuations. So going forward, if you look at the week, in this week the sectors in focus, pharma was at up, which was at 3.5%, energy up at 2.5%, realty up by 2.3%. Now the energy and realty to a certain extent saw an uptick because of the fact what we saw in the interim budgets. And pharma, another reason that it came up was because it hasn't participated in the recent rally. So that's the reason that these three sectors have shown some kind of traction, whereas FMCG was down by 2.2%. Now in the previous section, in the previous video, what we had covered was the interim budget, and at that point in time we had talked about how housing, finance sector, or for that matter infrastructure, is getting a lot of focus, and housing being a part of that. We've studied this in a little bit more detail, and that's what we're going to cover in today's video apart from the regular bulletin. And we'll come up with our recommendations and why we are making those recommendations. So that's another section to this particular video. Then we'll cover a few Q3 results. And what we also wanted to point out was the RBI monetary policy, that RBI came up with no change in the repo rate. And because of that, some of the people who were expecting a change and more on helping reduce the interest rates were taken a little bit back, and because of that there was selling in the market, and that did bring down some of the gains that the market had taken in the early part of the week. So that's how this particular video is structured. So let's get into the housing finance sector and try and understand what has been the growth over the last decade for this sector. Now if you look at the growth in this sector over the last decade, has been around 15 to 16% in the last 10 in the last 10 years, and most of that growth has come from the urban areas. Then in the last 3 years, because of the COVID, what we have also seen is that there has been a little bit of slack, and it has grown at 12% versus the 15-16%. And that is primarily because of the higher loan rates and people taking less loans. Now, what we are expecting going forward is that the distribution in between the urban areas and the rural housing, there will be a lot of focus on rural housing, and that's where the growth will come from, and that's where the PM Awas Yojana is also focused. And this particular part is expected to grow at 22% for the next 5 years, and that's why there's a lot of focus on some of the companies that operate in the housing loan segment for this sector. And the companies that we are tracking are HUDCO, LIC Housing Finance, PNB Housing, and Canfin Homes. Now, some of these companies, especially like the HUDCO, that has run up a lot in the last 9 to 12 months. If you look at, it was trading at 6.6 to 7 PE for the last decade, and all of a sudden this particular stock is trading at 19.5 in this current cycle. So 19.5 of a PE, and whereas it has grown at 25, it has grown at 11% from a profit perspective. The trailing 12 months profit growth is also at 14%. The net profit margins are good at 25.8. So if I look at it, this stock is really doing very well on the net profit margin. But at the same time, it is one of the most, from a valuation perspective, it is one of the most expensive stocks that we are seeing at this point in time. There might be still some room for it to grow, but if I was to make my pick, I will not take fresh positions on this. And we already have positions on this, but we will not be taking any fresh positions. In fact, we would look to book some profit over a period of time in this particular stock. The next one being the LIC Housing Finance. If you look at the PE over here, it's at 7.35, whereas it has traded at 12.5. So the fact that it is trading at 7.35 is to a certain extent coming because of also the growth that it is witnessing. If you look at trailing 12 months profit growth, it is at whooping 73%. And that gives it a PEG ratio of 0.97, net profit margins at 17.2, not the best, but still good enough. And the cause of concern can be this one, that is 2.4% NPA. Now, that's probably a cause of concern, but if we were to make some investments and build some fresh positions, then LIC Housing Finance is the one on which we're going to build positions. PNB Housing Finance, if you look at it, always traded at 15.7, almost trading at the same level, but there might be room for growth over here. Trailing 12 months profit growth is reasonable at 45%. So if this continues, then this PE will come down and there might be more opportunity to buy over here. The PEG ratio is at 3.38, not the best. The net profit margins at 19.8 and NPA at 1.14. So in our list currently, this is something which we will track but not necessarily build positions at this point in time. The third one being the Canfin Homes. Now if you look at again over here, from a valuations perspective, it is almost trading at the same valuations that it is traded. The 5-year profit growth is reasonable at is best, I would say, at 17%. If I look at it, and the trailing 12 months profit is okay. It's not the best, but it's definitely good. PEG ratio at 0.91 definitely makes it a good buy from a growth as well as P ratio perspective. Net profit margins growing at 22%, which is very close to the way the HUDCO has grown. And overall NPA also at 0.49. So this is definitely something which needs to be tracked, and maybe the first one that I would still build my positions is LIC Housing Finance, but the second one might be the Canfin Homes. That's the way I would look at it. So those are the numbers from housing sector. Definitely a sector to look after, and maybe have 2 stocks from this particular segment if you're willing to invest. But there are private players also in this, and these are all semi-government owned. So that's how we're looking at it at this point in time, and make your own calls based on the numbers. Now coming back to the last segment of the video, as we discussed earlier, that is the Q3 results. So some of the power companies which we are tracking, they share the results. The first one being the Tata Power. Let's look at their numbers. The revenue up by 3.7% and profit at 2.2% growth year on year. EBITDA 15% year on year. Green power generation up by 23%. So that's definitely a green shoot over there. Now the guidance from the management is that they are targeting the 15 gigawatt renewable capacity by 2025 and exploring pumped hydro opportunities, which should give us better revenue streams and the areas in which the overall markets are focused. The management definitely acknowledged the headwinds because of the rising coal prices and the regulatory uncertainties. And it is committed to gradual debt reduction through internal accruals and asset sales. So that's how Tata Power is in terms of the guidance for revenue. It's at 8 to 10% driven by renewables and distribution business. Now, if you look at how the market responded to the results, it was down by 3.8% because the market was giving it a premium somewhere around for a revenue earnings estimate of 1200 CR, whereas it reported 1076 CR. And if you look at the trailing 12 month stock P, it has been at 36.6 and it expanded from 17.6 from April 2023. So that's a significant number, and because of that we do feel that this stock at this point in time is fairly heated up, and if you hold position, then maybe it's good time to book some profits and then rebuild positions if needed. So that's how we are looking at Tata Power. The other one that came up with results was the Power Grid. Revenue up by 2.6%, profit up by 10.5%, EBITDA up 3%, dividend declaration of 4.5 rupees per share. Now, from how the market responded, the stock was up by 3% after the earnings results. And if you look at over here, the overall this thing, it has at trading at 16.1 and it has expanded from 11 in 2000 from April 23. So the overall outlook for the power sector is positive, and maybe this is still a good stock to invest at this point in time is the way we're looking at it. There are many more power companies in the fray, like we did an analysis of housing sector this week. Next week we're going to cover the power sector. Overall, a reasonable week for Nifty. What is expected in the next week is probably still a sideways movement only because there are no major macroeconomic changes or the policy changes. So stay invested, keep an eye on the market and keep learning, because once you learn, control your emotions and work analytically, you will be able to make more profits with conviction and make right investments. So I'll see you in the next week. Hope you liked it, and do tell us if you want us to cover any specific sector or any specific topic. Bye for now.